So when you hear that the Federal Reserve needs to get inflation in check, they're making the assumption that the inflation is coming because of a overheated economy. Things are almost too good, and when that happens, things are really good. They need to slow it down. Well, the only way they can slow it down is to raise rates, and when they raise rates, then capital doesn't flow quite as quickly. It starts to slow down, and hence the economy slows down. So the overheating of the economy slows down, and that theoretically should get inflation in check. It doesn't always work. Ask Jimmy Carter. It doesn't work all the time. But that's how it works. The upside, why I always tend to lean towards raising rates as opposed to not to doing that, because it's generally about the same time that the dollar is somewhat devaluing or becoming weaker. Now, that hasn't happened in a long, long time. Why? Because everybody else is even weaker. So our dollar is measured against a basket of currencies, right? Different currencies, 4 to be specific, other than ourselves. And we look at that and we say, well, you know what? We're the best looking horse in the glue factory. So we have maintained a value. When you cut the rate, it devalues the dollar. It devalues the dollar. In my opinion, I don't think that's ever good, but I'm a staunch dollar person. I believe that strong currency inevitably leads to strong economy, strong companies, strong consumers, so on and so forth. Ask Norway, the greatest sovereign wealth fund in the world. They could attest to that. As a matter of fact, 3 weeks ago, Norway raised the rates. Everybody else has gone to negative. Norway's raising rates. Didn't impact their economy at all. Everybody has great faith in the central bank, and their currency got even stronger. So we have been in a weak kind of mode for a very long time. But remember, you've got a Treasury Department that says we can't afford. Listen, if we get anywhere normalized in rates, if we start seeing inflation and we start having organic inflation, which we've had, that rates are going up despite what we do, then we ought to realize that we don't have any control over inflation like we did 30 years ago. It doesn't work that way anymore. So when that happens, interest rates go up. And what happens to our national debt of 30 trillion or close to it? Now we've got to pay more interest to service our debt. That interest that we pay goes towards our debt. That becomes another debt for us. So we don't want to get normalized interest rates. That would be somewhere around, nowadays, would probably be somewhere around 3.25%, 3.5%. That would be adding $1 trillion every year to our debt and interest. Give you an example, in Japan, the number one expense in Japan is interest on their debt. It's more than their whole defense budget. It's more than all their public services. It's more than anything. It's their largest budget item for the government is the service, the interest rate on their own debt that they have to pay. So it keeps piling on to the debt. It's simple, but it's complicated in all the things because it's so intertwined. It's so intertwined. And all we care about is how much interest rate do we have to pay on our mortgage, or how much interest, how much money is money is our dollar worth, really? How many bags of rice can we buy with our dollar? How many gallons of gas can we get for our dollar? That's what we care about. If you were Kellogg's or General Foods, you would care about how much wheat you can buy to make the cereal you need to make. You would care about how much that dollar is buying in wheat. If it's lower, if the dollar is devalued, it takes more of those dollars to buy the bushel of wheat. It takes more of those dollars to buy a barrel of oil. That's called inflation. So a valuable currency, not highly valued, but a valued currency that is reasonable, is a very healthy thing for consumers and a country. It's very healthy. And we haven't been able to add value to our dollar other than what has been added organically, what has happened in spite of the Federal Reserve.
Hey, remember to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.